Morning all. Sorry, having technical difficulties again this morning. It's going to be technical difficulty week this week. Morning Danny, morning voice check, morning Sebastian, how are we all doing? Happy Wednesday. It is Wednesday. Markets are open. FTSE's gone off through the roof. Huge move this morning on the FTSE. Right up at yesterday's high, just broke it straight through yesterday's high actually. So yeah, very big move there going on. Not quite sure why the market's so aggressive on the FTSE this morning, but it's having a nice big morning. So I'll be trading that hopefully, and it might even be a bit big. 18, no, that's fine. So definitely getting a trade on the FTSE this morning. Morning Leon. So today, I was hoping to get the access to the new fundamental website, but it's just not ready yet. So I can't do that at the moment, but it's very close. So I'm hoping in the next couple of days to be able to give you testing access to that. They were working out yesterday bugs with the email system, the fundamental system, and they want to get a live account tracking system in place as well, which they need to get an EA built, which I've got to work on for them, and I haven't managed to look at it yet. So I'll hopefully get that sorted in the next few days, but it's one of those things where it's just dragging on a little bit, development. But so just a quick look at the news today before we kick off. The rate came out yesterday on the Australian dollar positive. We were forecasting a drop on the Aussie and it went up, obviously. So we had a big move up on the Australian dollar yesterday. I'm just going to go through something with the EA this morning with you. I took an Aussie short on Monday in anticipation of that drop weakening the Aussie dollar, and obviously we got totally the opposite. So I scaled into two positions yesterday to try and get out of that today on a retest of propulsion, just to exit the position, but so far it's holding up there. So I'm hoping we get a little bit of a pullback on that today, but that was really unexpected. As you look back through the Aussie interest rates, it's very, very rare that they do something unexpected. So yesterday was quite a hit, basically. So big pop on the Aussie dollar as the banks and institutions reposition themselves, because obviously they got the wrong exposure, basically, because they were forecasting a drop. So there's potential for that Aussie dollar to continue for quite a few days. So I'm looking to try and get out of that as soon as I can. The New Zealand rate this morning came out as forecast. As you can see from the ADR dash, no impact whatsoever. The New Zealand dollar had kind of a little bit of a sort of spike on it, but it's not really doing an awful lot. So nothing much particularly exciting on that. It is strengthening slightly. But apart from that, there's no more news today. That's it. So it's a kind of a dead news day again today. We've got unemployment claims, and then we've got the unemployment rate for the CAD on Friday. So it's a bit of a weird week this week, very, very contracted with the news. Overnight, we had an awful lot of news coming out with Trump. Trump is on a mission again. So there's your New Zealand rate coming out this morning. Trump basically put 50% copper tariffs on last night. We expect, as it says there, we expect 15 to 20 trade letters to go out over the next 2 days. So basically, he is, you see what happens with copper. Look, huge spike there. Play that forward? No. Haven't actually got copper, but there's a huge spike, obviously, on the copper there, because obviously there was a 50% tariff put on that. He is threatening 50 to 70% tariffs on multiple countries over the next few days, and 200% tariff on pharma. So again, we're getting to the point where he is starting to talk up the tariffs because people haven't been coming begging to him as he was expecting. So we've got this problem now where obviously they're going to be doing more tariff deals. He's been threatening BRICS again. If you're in BRICS, you're getting a 10% tariff. That's a given. So yeah, we've got to be prepared for some big volatility over the next few days. Swiss franc rallies potentially, and obviously stock indices that flicking back down into here again. So if you look at the stock indices from yesterday, they didn't really do a lot yesterday. Broken long on the FTSE, no trade on the DAX. Why is my open profit minus? Oh yes, drawdown. That's right. So yeah, if you look at the indices yesterday, we had quite a sort of sideways session yesterday. As you can see from my P&L, took quite a big loss yesterday. I've recouped half of that back already today on another trade, which I basically took to kind of counteract what happened yesterday. But we had a big drop on Monday and then a kind of a grind down on the Dow yesterday. If you look at the NASDAQ and the S&P, very similar there. We just kind of sat around. So I get the feeling the market is now gone back into holy crap, we've got more tariffs coming mode. We need to start scaling out of risky assets. So there's a big chance that the stock market, if these tariff letters start to go out with big numbers on them, we are going to get that drop down again. So just be prepared for that. Long biases are probably going to be quite hard to make work. If you have biases, you shouldn't have a bias in the stock indices, but that's probably what we're going to do until we get that news coming out. So probably a good idea to start limiting risk a little bit at the moment. DAX is out at all-time highs again. Not all-time highs, sorry. Recent highs, approaching the all-time highs, which is ADR today, that monthly high. So there's a lot of potential pullback, as you can see on these US indices, and that will drag all the other indices down. So just got to be aware. It looks like it's starting again, which is going to obviously have an impact on all markets. So it's really risky at the minute with what, he's just kind of a loose cannon at the minute. And it kind of just flares up very, very quickly when he gets cross, obviously, and tariffs start to come out. He swore at Putin yesterday. It's getting a little odd again. So just be prepared for that volatility in the markets at the moment. ADR reversals, when you get this type of price action, obviously is a little bit risky. So just be a bit cautious. Stopped out on the FTSE. So basically going to be looking for either a break long or short. Can't get into the DAXs today. Oh, that's so close. I kind of want to get a DAX trade on. I'm going to cheat. I'm going to switch down to 15% of ADR on the DAX. Just to make sure I get a trade on that. I get the feeling today we're going to get a move because of yesterday's kind of sideways price action. We quite often will have a period of downtime and then we get some movement. So I think the trade tariffs were being announced. We kind of knew they were coming. The market was sitting there waiting. So today we're probably going to get a move started, I think. So be keen to get on that DAX. Right. So that's really the news we've got overnight and what's coming up. This morning, Pete's not in here. Pete never comes in here. There's a member who's been here for ages called Pete, and he messaged me asking about what we covered on Monday about the 80-20 RSI. So what I was going to do this morning was go through the position trader EA in the strategy tester and focus in on that 80-20 RSI. So obviously I covered this on Monday, but we get this very strong signal at 80-20 on the hourly and the 4-hourly RSI, which doesn't come around very often. This is probably not the best thing to look at a stock index, is it? So let's look at a major, pound US dollar. So you get these readings every now and again where you get these 80-20s, and they typically are caused by something usually by something fundamental. So they're usually either a change in interest rate, a change in monetary policy, morning Mark, or something along those lines where we get a very fast parabolic move, tends to be an ADR, 200 ADR, and it tends to last a few days. So you'll get an ADR hit followed by an ADR hit followed by potentially an ADR hit. And that just takes the RSI from wherever it was to extremely overextended conditions or underextended conditions, which don't come around very often. So when you get these signals, these 80-20s, which I covered on Monday because we had a few of them, didn't we? They tend to be incredibly reliable signals. So he was asking about a stop-loss based strategy to do with them. And you can do this with the position trader EA. So I was going to go through that this morning, mainly for his benefit, because he never turns up. So you can watch the replay and look at ways to use either stop losses or use, because he said about using a stop loss based strategy, but I would be more inclined to use a position trading strategy with drawdown control rather than a fixed stop to benefit from these 80-20s. So it's the sort of thing you would kind of set up as a separate account. And have running if you wanted to with just this one strategy running pretty much on all pairs because you're not going to get the 80-20 extensions on all of the same currencies at the same time. If we look at this one here, can you see it behind my head? Yeah, you can. Strategy test is open. So you got this one here, for example. If you look at the other pound pairs, like the pound odd, we didn't get the extension there. Pound CAD, you didn't get the extension. Pound Swiss, you didn't get the extension. So it's one of those things that tends to happen on a single currency, not on an individual currency pair, not a single currency at a time. So what it is when you get something like the pound having a really strong move, there will be another currency which is particularly weak at that point in time. And the pound will be able to get a much bigger move against that one. So, for example, at the moment, we've got a very weak yen. So if the pound was to suddenly strengthen up, the pound yen would probably be the biggest beneficiary, the fastest, biggest move. So it's the sort of thing you can run on any currency pair, and you're not going to get overexposed on it because you're unlikely to get extended on multiple pairs at the same time to this level because it requires a currency to be very, very weak and another one to be very strong at the same time. So we're going to run a test. I'm just going to start it on Euro US dollar. Let's go back to 2023. Go back a bit longer. So there's many ways you can do it. Obviously, I prefer the 4-hour time frame for these types of setups because it means that you've got a longer sort of move that's happened, but hourly time frame is kind of the bread and butter, if you like, because you're going to get a lot more signals on it than you are on the 4-hour because these don't come along very often. So what we'll do is we'll run the RSI mean reversion strategy because this is going to be a kind of hybrid stroke stop loss based strategy. We can go in with a lot bigger risk, so 1% risk over 1 ADR. We're expecting to get that move play out very, very quickly. Yeah, so it's the sort of thing you can get in with higher risk on. Maybe a bit too high, but we'll try it and see where we go. Lot multiplication, again, because it's a kind of high risk stop loss based strategy. Any strategy, stop loss is high risk, obviously, because there's a high probability to get stopped out. But we'll use a higher multiplier on this. And we'll keep the distance fairly close together. So if we're getting extended above those 80 levels, what we're looking to try and do is get out pretty quick with a decent risk and a decent reward. Yeah. So just in case it does obviously continue to fly. So we'll try using half an ADR initially. These would be kind of a good starting point. And obviously we can do system parameter permutation testing on this to see if there are better options, which is something we can obviously do at a later stage as well. So targets for single trades will go for just half an ADR, which would be 0.5% profit. For multiple trades, 1 ADR seems pretty decent, but let's go with half an ADR at the moment. And then I guess we could just use half an ADR, couldn't we? Yeah, let's scrap those for the minute. Just use half an ADR as a target. This would be a good one to do a system permutation test on. So drawdown control, if we're going to use stop losses, delete stop losses on normal entries, true. If we want to set that to false, obviously you're going to put hard stops in at 1 ADR. So we don't want to do that. We want to be able to scale into the trades. So what I'm going to do is use drawdown control on a percentage of drawdown. And because we're risking 1% over 1 ADR, we want to give ourselves maybe a couple of ADR of movement. So at 2 ADR, we will start to scale out of the positions. So when you get to this point where you've got extended beyond the 80 level, we're not expecting to go much further. We very, very rarely ever get to 90. 90 is super elusive. And again, this is something we can test the 90 level as well, and even the 85. But we would expect some kind of pullback before we manage to get 2 ADR beyond that level. So that should be a pretty safe level, because if we're pushing up and then we're taking a trade and we're using a 1 ADR 1% stop, it's got to push at least 1 ADR against us to go 1% into drawdown. Then we're going to take another trade somewhere in here, and it's got to push another ADR before we start doing drawdown control. So what we're saying is when you get extended above 80, get in and then start to scale in. But if it continues 2 ADR against you, something is parabolically wrong, isn't it? Something's gone massively wrong that it's managed to get that far. So that should be a pretty safe drawdown control facility. The other option we could use is to use drawdown based on number of trades. So if we're scaling in half an ADR apart, when we get into 3 trades, then we could start closing out. But I think you're better off using a percentage drawdown to start with, because what's going to happen is potentially you're going to go into an accumulation. RSI is going to reset and then push again. Those are the ones where you need to start scaling out on. So we don't want to go number of trades, because if you do get 3 trades on half an ADR apart and it pushes a little bit more before it drops, you're just going to take losses unnecessarily. So that's probably the best setting to use there. Not going to use aggressive drawdown control, but again, you could do that, but it's going to be scaling in a bit too quick. So 21 1 hour RSI 80-20 is what we're going to use. Last candle must be closed beyond the RSI. That's fine. And we will use either a 3-bar reversal or a moving average entry. So I'm going to go with a standard 9 on the 15-minute time frame to start with. Using hourly, probably want to use a 5. And normal everything else in there. So we'll run this on the 15. Okay. We'll do visuals to start with so we can have a look at this running. So the idea here, we're not going to get many trades because obviously when we're running this 80-20, we know we don't get there very often. So if you look at this pound New Zealand, for example, I'm scaled out here back to March. We just about had a signal there, just about. If we look at something like the pound Swiss, again, we've had one signal back down here. Again, Swiss franc, not going to be a great one to do this on. Chances are it's a safe haven run if we get extended on the Swissy. So may or may not work. But if we try something like the Euro US dollar, you can see that we've had 2 signals or 2 conditions, 3 conditions really, to get in on the Euro US dollar, there, and there. And as you can see from those entries, you're getting roughly 3/4 to 1 ADR. We're targeting half an ADR because we're trying to scalp out with the high risk. So let me just speed that up. Oh, we've already taken some trades. Okay, let me slow that down again. Wow. Just really getting that extended that quick? Okay, we've had quite a few entries by the looks of things. That was a lucky exit. Would have got out there. Okay, so I'm just going to monitor this RSI level. 3 trades, that's very quick. And another one. And another one there. Wow. So we are getting quite a few entries. When is this? March 2023. I'm going to quickly have a look at what was going on in March 2023. Yeah, we've got a few entries actually, haven't we? So we have got quite a few extensions, look, in March. We had a very volatile time. Okay. So yeah, there we go. So it's taken 1, 2, 3, 4, 5 trades so far. 5 winners, singles. So you notice that we're not getting double trades on. It's all singles at the moment. And this is the key to this strategy. It's the reason Pete was asking about it was because of prop, basically. So he's looking for an FTMO. He trades with FTMOs, looking for an FTMO strategy. There's an example of one that didn't work out. What we're looking for is something that is very, very, very high strike rate that you can get in with high risk on. So you're going to take some heat on it. You're going to take some drawdown on it. You're always going to do that because you're never going to get exactly the spot on right entry, although you do a lot of the times, as you can see with this, it's flying past and getting into really good entries. But when you don't get them, you are going to need to scale out of them fairly quickly because obviously with prop, you are going to hit those drawdown limits and you are going to blow accounts. So there, that one took 3, for example. So what we would have to do is do an export on this. I'm just going to reset this and just do an export. Export daily summary. Oops. 80/20. So I'm just going to run this again, but I'm going to do the daily summary so we can see what basically is going on with the drawdown files. So there's your equity curve. As you can see, pretty much straight up. You're going to get the odd drawdown. So you can see the drawdown there. You went from roughly 10,300 down to 9,700. So you took about $600 drawdown on a 10K account. Yeah. So that is obviously quite a big drawdown. So that would be an account blow, wouldn't it? Potentially, depending on which prop firm you're using, over 5% is usually a fail, isn't it? So maybe that risk is a little bit too aggressive for this one. But as you can see, the equity curve is always going to be very, very nice. So if you're using this on your own account, where obviously you haven't got drawdown limits, but you want to keep obviously fairly decent risk allocation, but you don't want to go overboard on it. It's got a very, very nice potential equity curve. This is probably the type of strategy you're going to want to run on majors. So the US dollar pairs, and again, with the US dollar pairs, you will probably find that when you get those RSI extensions, which are very extended, so they're on this case, potentially there. If you switch over to the other pairs, you can see you're not getting the same 80/20s on the US dollar Swiss. That's the US dollar CAD. If we go pound US dollar, again, you're not getting the same extensions on the other pairs. So it's one of those strategies where the equity curve is all going to play out individually, but you're not going to get multiple trades on the same instruments or the same currencies at the same time. Because if we're trading all the majors, for example, everything against the US dollar, as you can see, you're not getting those 80/20 extensions. One thing you have got to be aware of is negative correlation. So Aussie US and US CAD, 2 commodity pairs, Canadian and Australian dollar against the US, you're going to get them inversely correlated. So where you would be on the US dollar CAD going long, short rather, on the Aussie US, you will be going long. So these are going to be slightly correlated. There's no trade there. There's no trade there. So you would have had 2 correlated trades there on those two. So it's pretty safe to run on most currency pairs, I think. But that gives you an idea of equity curve and what you can expect. I'm just trying to, there we go. Just waiting for this to finish running. Shut that one down. See if it takes any more trades. And again, this, you can test this as well with different levels and with different RSIs. Obviously, the 70-30 is not what this is designed to do. 70-30 is kind of your usual market movement, market structure. The 80-20 is the extreme movement. So this is where you're getting multiple pushes at the same time. If you're grinding away, you're not going to hit those 80-20 levels. It's when you get a parabolic movement, which is what we're looking to take advantage of, when they take that initial profit take and then they carry that move on. So you've got to be out quick with short movement. There we go. There's another one there. That was a quick in and out. Very quick profit. How far have we got to go? I'll let it run a little bit longer. Obviously, this is relative to your account size. Obviously, we're using percentage risk, so it will obviously increment that. But this account is up 15% in roughly a year on an individual currency, obviously. So 15% on one currency, multiply that by however many you're going to trade. That's your potential, obviously, earnings. So if you're trading a 100K account or something like that with FTMO, you're multiplying this up to, you know, 15 grand per instrument per year, which is, you know, a sizable amount of money, isn't it? But you are going to be sitting in trades in your account for ages, not taking trades, which is the key thing to take away from this. Anything that's got an incredibly high strike rate is going to have an incredibly low number of trades. Yeah, because obviously if you're taking the biggest, highest probability setups, they're the ones that don't come around too often, aren't they? So you're going to sit there for weeks on end going, there's no trades. So it's a kind of a patience strategy, but it's a big profit one. So I'm just going to let this run out a little bit more, just see if we can get some more drawdown. There we go. So you've got some more drawdown taken there. I'm just trying to see what the drawdown is on it, because that's one of the questions he had was about drawdown. So this will give us a good idea when I open up the spreadsheet export. So we're still up 15% again. Where's my phone going? Someone at the door. Another one there. I'll stop it there. Shall I let it run? I'm just going to let it run because I want to see. We've gone through Trump here. One of the things we're going up to June. So one of the things I was interested in looking at, or are we in 24? Yeah, 25, is obviously what happened during Trump and his crazy moves, because we got quite a lot of 80-20 extensions then. We've gone through that, and obviously we've survived with obviously some drawdown, because you are going to get drawdown when those massive parabolic moves. But there you go. So that's kind of 15% return over the year. Profit factor 2.31, very, very good. Strike rate 68%. So, you know, when I've talked about this in the member streams before as well. Strike rates, everybody's like, oh, we're going to get a strategy with a 1-to-1 risk reward ratio with a 70% strike rate. That's the holy grail. That sort of thing is not around very often, is it? that 68% strike rate is pretty typical of a mean reversion strategy with high win rate. Anything above 70% is virtually non-existent. So you're always going to have to take that drawdown. Now, there's a lot that you can do in the optimizer to optimize this. So multiples of ADR for exits, if you reduce that down, you are going to get a higher strike rate. It's going to be less profitable, but you'll be out of those trades a lot faster. Those ones where it goes beyond the 80 level and we're getting up to the 90 level, you're still going to take those losses though. So that's the key. We're looking at what's going on with those drawdowns. So let's open that spreadsheet and have a look at the drawdown. So this is the export from the position trader EA. Just quickly see what's going on with the indices this morning. Oh, I've got a trade running. I haven't got any margin left. Oh, I haven't taken along on the DAX. I've got no margin on this account now. Oh, doesn't matter. So there is a long break on the DAX. Just quickly open this one up. Sorry, bear with me. I'm expecting somebody to come with a delivery this morning. The dog's going mad, which usually means there's someone coming. So this is the export of the position trader EA. So it obviously gives you the ADR, it gives you your account balance, it gives you your equity. When you're in trades, it gives you what your profit is and your lot sizes are at the end of day. So you can see that basically every single day at midnight, it's exporting, morning Chris, the data from your account to give you an idea of what your drawdown will have been. It gives you your open profit and drawdown and you're closed. So this column here is the one that you're interested in. So this you can say as a percentage is that times your balance. No, is sorry, maths today. Is that divided by a balance? Yeah. Okay, so that's 0.08% drawdown. So what this column will do is it will give us what you are in drawdown as a percentage of your balance, basically. So if we scroll down and have a look through, we went into, at that point there, on that day, we had multiple trades open. We were 3.4% in drawdown. So if you're in an account that has a maximum 5% drawdown, open drawdown, something like FTMO, you didn't blow the account, you were safe. But this is just one instrument. So on that particular date in July 2023, if you had more than one trade open and you were being squeezed into two parabolic moves at the same time, that is when you're likely to blow the account. So you've got to be a bit, take these numbers with a little bit of a pinch of salt, because while these are accurate, at the end of the day, we were in 1.89. It could have fluctuated up by 0.5% or down by 0.5% during the day. So it's never going to be 100% accurate, but it gives you a good gauge as to how deep into drawdown you're going on the account. So as you can see, as we're flicking through, you've got a 3.95 there. So it went to 4% of drawdown, 2.75, so sub 3%. 3.96, so 4% again. So it looks like the maximum at end of day we had was 4% drawdown on this one instrument. So on a prop account, that would have survived absolutely fine, and it would have returned you is that your cumulative P&L? Close profit, yeah. That's the cumulative in it, yeah. So your ending balance was 11,578. So basically a 15% increase on the account. So it will survive quite nicely. Now, obviously, you can run optimizations on this, which I will leave to you to do if you want to do it. Multiples of ADR as target are one of the main system parameter permutations you're going to be able to affect drawdown with, because the smaller your target, the faster your exit, usually the lower your drawdown. So that is something that would be worth testing probably in 0.25 increments. So go with 0.25% target in 0.25% increments up to, I mean, it depends what you want to do. To bear in mind, we've gone parabolic 80 or 20 extension on the RSI. There's a reason for that. So there's probably going to be a continuation on some of these. So maybe targeting 1.5 ADR as a target, as a max, but you can try whatever you want on it. So that's one of the system parameter permutations to test. This percentage risk over ADR, that is going to have a direct impact on your drawdown figure. So we were looking at that spreadsheet there, getting up to around about 4% drawdown. If that's too high, you drop this down to 0.5, you would be in 2% of drawdown. Yeah, so this is going to have a direct correlation with your drawdown figure. It's also going to have a direct correlation with your profitability. So where we made 15% on that individual currency, if you double that, you're going to double your, obviously, profitability. Now, bear in mind, this will compound as well. So this is assuming you're taking nothing out of your account, which you will do. So it might actually be a better idea, instead of using a percentage risk, to use a monetary amount. So if we were using 1% on a 10K account, you're probably going to want to go with $100 as a risk amount initially, or maybe higher. So it might be better to use monetary risk, because what you're going to do then is you're going to take the compounding effect out of the back test, and you're just going to be risking exactly the same amount of money every single time. So we're assuming if you're doing this on prop, you're going to be building the account up, withdrawing, building the account up, withdrawing. So that is a better risk parameter probably to use than using a percentage, because you're not going to compound on the account. The lot multiplier obviously will also have an impact on the profitability. It will also have an impact on the drawdown. So that is, again, something that is worth back testing. So starting at 1, going in 0.1 increments up to, say, 1.5, which is what it's set at the moment. That's a good parameter permutation test to do, to see what the difference is between not increasing lot size on those ones that you need to get in. You saw during the back test, there's quite a few. Actually, it wasn't quite a few. There was 2 or 3, wasn't there, where we went into 2 or 3, and in some cases, sort of 4 or 5 trades, and it was scaling out of those. It's looking at that will impact your drawdown massively. So we were using a 1.3 multiplier. If you use a 1, you won't get anywhere near that 3% or 4% drawdown. You'll be a lot lower, obviously. So bear with me 1 second. Don't forget that. I've got somebody coming round to inspect the house today. We've got a snagging report coming, snagging guy coming, who basically goes around the entire house and writes a snagging list for the builder. So he's coming this morning, so I've got to be prepared for him, which I've got to go actually in about 10 minutes. So distance between trades as a percentage of ADR, that is also going to have an impact on your drawdown. So bear in mind, obviously, we're using an 80-20 extension here. When you're getting extended above that 80 level or below that 20 level, the distance between trades is going to have an impact. Because we've gone so far, the likelihood is the market can't push massively far against you. It's more likely to either bounce, as we see with a lot of those, and what were just 1 in 1 outs, weren't they? But when we were getting into 2 or 3 trades at half an ADR apart, we could space that to 0.75. And what that will do is it will get you into less trades. And again, that will reduce your drawdown. But you will get into less trades. So all of these are going to have an impact on the drawdown, which is the most important thing with this if you're using it on prop, for how it's going to affect, potential of account blowing, basically. So, or not account blowing, but, hitting drawdown limits. So again, distance between trades, you could try going in 0.25 and go in 0.25 increments up to 1 ADR apart. If you're getting in closer together, when you're really extended, if it goes a little bit more, a quarter of an ADR, and you take another trade and it pulls back a little bit, don't forget your average is moving down as you scale in. So getting out with half an ADR with two positions which are really close together is actually probably easier than if you space them further apart. You've got to wait for it to get further because your average isn't going to be as tight, is it, to where price currently is. So again, that is something that's worth testing. So these are the key things. Monetary risk, I think, is probably the best way to go to make sure that you're getting a stable playground with risk, because you're going to be withdrawing from it. It won't be compounding. Watch these two for affecting drawdown, and obviously your exit target to see how far these will go. So what you will find is, as you increase that, typically the strike rate will tend to sort of drop. So all of these are worth testing to see what gives you kind of optimal results. Ideally, what you would look for when you're doing this type of testing is on multiple instruments, you want to be getting roughly the same results from your system parameter permutation tests across all of them. So what you want to see is, if you test pound US dollar, euro US dollar CAD, Swiss and yen, I would, because the safe haven runs will usually hit 80-20 levels, and they will tend to continue if they're safe haven runs. I think yen and Swiss you probably want to steer clear of. So pound US dollar, euro US dollar CAD, any other euro pairs, euro CAD, some of the Aussie pairs, commodities again will rally on safe haven runs. So the Aussie dollar pairs potentially will be a bit more squeezy, but again, just test them. But test these out, and you want to see that targeting a quarter of an ADR has the same impact on all pairs. It makes it better or worse on all of them. This distance between trades makes it better or worse on all of them. So analyze the results of all of the system parameter permutation tests and pick settings that seem to work well across all instruments, because that means you're not curve fitting individual settings to individual instruments that you're trading. You're making sure that you've got an overall strategy that fits the FX market, not an individual euro US dollar, but it doesn't work on US CAD. If you're on US CAD, you've got to use 1 ADR between the trades, 1.5 multiplier, and everything else you need to use a half an ADR and a 1.1 multiplier. You're curve fitting the results for that pair. So you want to try and get a universal set of entries, basically. The other input that is potentially worth testing is obviously the drawdown control. But this is kind of a scalping strategy. So we want to be out of these trades fairly quickly if they don't work. So that 2% in drawdown, bear in mind, if you're trading prop, if something goes into 2% of drawdown, it's not far away from getting to the point where you're going to lose the account. So you've really got to start to scale out of these quickly if they don't work. You've got to leave it some breathing room. So 2 ADR of movement after an initial entry is good. But bear in mind, if you're scaling in half an ADR apart, by the time this gets to 1 ADR and drawdown, this one's in 1%. By the time that your second entry gets there, you've got another 0.5%. So by the time you've moved 1 ADR against you, you're actually in 1.5% of drawdown. Any movement 1.5 ADR against you takes you into 2% drawdown, and that will start to scale out. So we're saying get into a trade, take a second one. If we carry on going, we've got to start moving out of these trades to get that average closer so that we can get that quick half an ADR exit. So this is a scalping strategy with high risk. So you could try this without a stop loss, which was kind of his recommendation, but I think you're better off using drawdown control, because you're going to take 100% loss on something that, if it gets to 80 on the RSI and then does that, yeah, you're going to take 100% loss, whereas you should be scaling out in anticipation of that move rather than just going, I'll take the loss, and then the move works in your favor. With this way, you're going to be recouping some of that loss along the way. So these areas here where we're obviously hitting this drawdown, yeah, here, can't see that one behind my head, but in here, these would have been 100% losses rather than gradual recoveries. Yeah, so you would be taking big dips here, which is entirely personal. You know, you can take big losses, or not big losses, but take the losses in full. But if you scale out of the losses, what you're doing is you're moving price closer. You're moving your average closer to current price, meaning your exit is quicker. If you're taking a full loss, obviously it's going to be easier to get out of any additional positions, but you're taking a full loss. And what that will do is recoup less than your total loss. So it means every time you get extended above 80 and you need to get into 3 trades, you're guaranteed a losing position in total. Whereas if you're scaling out a percentage, you can recover all of that basically on the move back down. So, you know, I think, you know, his sort of approach was, I want to use a stop loss based strategy because it's prop. I don't think you have to use a stop loss based strategy on prop. You just have to manage risk on prop a lot better, obviously. So we haven't got the room to breathe that we have on our own accounts. If you're doing this on your own account, obviously, you can do what you like. You can set this to much higher. And you'll probably find if I set this to, if I set this to 4%, because we saw that our drawdown didn't really get above 4%. I think it was only once, wasn't it? So if you set that to 4%, and I rerun this test, I won't do it in visual mode, I'll do it without visual so it runs faster. You'll find that this should generate a lot more profit, because what we're going to be doing is we won't be taking those drawdowns at the 2% mark, because we don't care about going into 4% of drawdown, because it's our account, it's our money. I'm a lot looser with my own capital than you can be with prop. So the equity curve, as you can see, is a hell of a lot smoother, because we are riding drawdown, basically, rather than having to scale out. So there was one scale out there, look. Yeah, so we did scale out there, but we obviously, so that one there would have had probably 4 trades on. Oh no, maybe not. Yeah, I mean, we haven't had any trades, any positions with more than 3 trades on at the moment. Look, it's all singles and doubles and triples. Triples? Back in Star Trek mode. Trebles. So 3 trades max on the 80-20s. There we go. So we got one there where we got 5 on. So that one there, we had 5 on the 20th of March. Tariffs? 20th of March? I can't remember. So where are we? 20th of March, Euro US dollar. 20th of March 2025. So that's now. Right, so it's here. Look. So we got in on the 5th of March on that extension. We didn't get half an ADR of pullback until the 20th of March here. So it was a scale in, 5 trades, and that was your exit there. So that was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 3-week hold, roughly. So that's the worst case scenario you've had in 2 years, is a 3-week hold, taking 5 trades. Let me export, just open this up and just see what the drawdown was on it. Oh, wrong way. Really? 1%. And there we go. 7%. There we go. So 7% drawdown. We made 24% on the account over that period. So you can see the profitability, the profit was double. But you took 7% drawdown instead of 4%. So double the profit, not quite double the drawdown, but was a little bit hairier, wasn't it? Taking a 7% on an individual. So yeah, it is a very good, very, very good strategy. It's something I've talked about in here regularly. I'm constantly going on about the 80-20 level on RSI being kind of the holy grail as you can get. There you go. So the profitability on that was 30k. So sorry, 3k. So 30% is the gross profit on it. That is using 1% risk. If we rerun the strategy quickly, oh no, sorry, I changed it to money risk. There we go. So I changed it over to money risk. So we were using money risk. So that is basically withdrawable cash, because obviously you can just take out the profit using exactly the same risk every trade. We're not compounding. Be interesting to see what compounding difference is on that. Instead of using a fixed money, if we use a percentage risk, just be interesting to see what the difference is. We had 3k, didn't we? 30%. So I'll just rerun it using percentage risk, which obviously will be slightly incrementing your risk as your account grows, which obviously compounds the profitability, but also compounds the drawdown. So your drawdown will also increase. Don't think that will have saved because I had the sheet open. I'll see. Let's get to the end of this one and we'll see what the profitability is. Sebastian, after back testing, I discovered 2 days ago the JPY basket. That's an index for JPY. It's available on TradingView. Can you have a look on it? I think there's a good reversal zones ahead. I can't look at that, no, because we don't have it. We don't have a JPY basket. That'll be a futures. So that'll be 6. That will be 6J. Is the Japanese yen. So this is the Japanese yen basket in futures. So if you look in futures markets, if you just type in 6, that will give you all of the base currencies, basically. So the Australian dollar, the pound, the Canadian dollar, the Japanese yen, Swiss franc, New Zealand dollar. That's all of them. So, and the euro, 6E. So basically what these are, I don't know if that yen basket is the same thing, actually, but what this is the Japanese yen. So these are basically the cross with the US dollar, pretty much. So if you look at, let me look at the British pound, 6B. Yeah, so this is 6B on the 5-minute chart. This is pound US dollar on the 5-minute chart. Yeah, so you see the price action here. Got a nice big long wick there. Yeah. There's your nice big long wick. So this basically is pound US dollar in futures. So if you want to trade futures, but you still want to trade FX pairs, all you do is you trade the 6s, as they're known, for obvious reason. That's Aussie dollar, US dollar, that's pound US dollar, that's CAD, US dollar CAD, that's US dollar yen, US dollar Swiss, US dollar New Zealand, or New Zealand dollar US dollar. Yeah. So these are basically the FX pairs, the major FX crosses. But that Japanese basket, I don't know. It's not something that I have in we have in CFDs. Right. So that gave us 34k. Sorry, 34%. So there you go. So using a percentage risk, obviously you are compounding. You're going to get higher profitability, but you will also, let's have a look, take higher drawdown. So not 1% max. Where are you getting 1% from? That's definitely, oh, sorry, min I want, not max. 9%. So 9% drawdown. So that's a lot more, obviously, than 7, and a lot more than our original 4. So like I say, it's all relative. If you increase the risk, you increase the drawdown and you increase the profit. But you look at the strike rate here. So not using drawdown control until we get to 4% in total on an individual position gives our strike rate now 85%. So 85% of our trades are profitable. The only reason that is 85% and not 100, as you can see by this, it is 100% strike rate. Positions is 100% strike rate. We haven't lost once. But we are losing trades because this one with 5 on, for example, we've got 5, 750, 760 profit, but we've got 280, 290 loss. So these are part of our 15% losing trades, but the position as a whole obviously is profitable. So you can't really take this into account when you're looking at position trading, because a position where you've got 3 trades and you get out here, you've got a winner, and a loser. Yeah, but it's 100% strike rate. We made money on the trade. It's a profitable trade overall, but a profitable position. But we have got losing trades within there. So the equity curve obviously shows you the profitability, but this is kind of a little bit false. If you're using a fixed stop loss, obviously this will be 100% accurate. If you hit the stop loss, it's a losing trade. You are losing all of that money. But as I say, that isn't the best thing to do. What time frame is the test over? So the test is running, this is M15. The only reason I'm doing it on M15 is for speed. If we run it on M5, you're going to get different results. But it's hourly time frame. So the RSI is hourly. There you go. I'll put this up so you can take a screenshot of this if you want. Or I can save this and stick it in the... let me just change that back to 100. I'll save this. Aussie MT4 8020 RSI. And this was tested on the EU. I'll stick this in the members group. Okay, so that's the members group. So go and do some system parameter permutation and test some other pairs as well with it. The test is run on M15. M15 time frame. I'll just put that in there. And it's using the hourly RSI extensions. The test period is from February 2023 until June 2025. So it's roughly June 2024, June 2023. So it's roughly 2 years, 3 months-ish. You probably want to do an out of sample test on it as well. So, but I mean, I'm not curve fitting anything here. You know, I'm just running the 80-20 strategy. I haven't said these are the best settings. This is just a test at random over a random time period. I've just picked out the blue basically. So you can go back. I'm going to obviously don't test it over COVID. It's not going to work over COVID. So April, anything from June 2020 onwards is going to give you realistic results of proper market conditions, and also surviving Trump. So yeah, so that's a good test to do. Sebastian, I don't want to trade it. I thought to use it as an indicator for the Swiss yen. You can do. You're better off. I mean, it's as an indicator using a basket of yens. You'd have to find out how it's calculated. The problem with using that type of thing is if it's a basket of yens, it's obviously an overall index of all the yen pairs put together. That index is going to be affected by how strong the pound is, the US dollar is, the CAD is, the Swiss is, and everything else is. Yeah, so it's not a true reading of yen strength. What it is how is the yen performing against the other crosses? How the other crosses perform will impact that index, which means you can't really use it for anything other than trading it itself. The yen is very weak at the moment. If you look at the currency strength meter, yen is incredibly weak at the minute. Where's the last currency strength? But it depends how it's calculated. You need to find out exactly how they calculate the index. Trying to find the last currency strength. Where the hell is it? Must have been yesterday's. There we go. So yen is light blue. There we are, all the way down there. So whenever you see anything down here, yeah, there's the Aussie dollar news, interest rates. Whenever you see anything all the way down here, for me, that is a signal to do the absolute opposite. If this is really, really weak, you want to be looking at buying it because it's moved down. Yeah, it will mean revert. Yeah, you can't go down forever. You can go down forever, obviously. And the yen has done that in the past. But that was before they sold all their US assets. So I would be looking at that potentially as powering up at some point. There's a trade deal on the cards for Japan. Why are you not finding? 47. Somewhere in here. Trump is looking at, he's in the final, there we go. Besant is planning a visit to Japan next week. According to people familiar with the matter, US Secretary Besant plans to visit Japan next week, the World Expo. Here we go. The visit would follow Trump's letter on Monday announcing his intention to raise tariffs on all Japanese imports to 25%, effective August the 1st. They are on the verge of doing a deal, which means that won't happen. That is why the yen is weakening at the moment, because they know there's a deal potentially coming to weaken the yen. It looks like they're going to sign a deal. This is why he's threatening all of these new tariffs, because he wants to get everyone to the table, basically. So I think you'll probably find that Japanese yen is going to power up fairly shortly. The concern at the moment is that we get a run on the Swiss franc because some of these tariffs might come out and send the dollar back down. Dollar down, indices down, Swiss franc up. We'll have to wait and see what he does. Yeah. I'll send later a screenshot in Discord. That's all right. We can have a look at it. Post it in the members group in Discord because we're the only people that know what you're talking about. But yeah, I don't know. There's lots of indices out there. You know, I've looked at in the past. I've looked at everything. I've looked at currency strength meters. I've looked at using index correlation and index negative correlation. The problem with everything in trading is whatever you're looking at is telling you what's happened. It has no indication of future. So the reason I love the RSI is the relative strength between two instruments. So it's a currency strength meter in itself that tells you that something has been strong and something has been weak. And in that respect, it's like the currency strength meter on here. You know, it shows you that the yen is weak. I can tell you that the RSI has been extended on a lot of yen pairs recently. Yeah, if you go and look in most of these yen pairs, yeah, you'll find RSI extensions on them. Not so much the New Zealand dollar yen, but things like the Swiss yen, obviously, and the euro yen, yeah. This is a currency strength meter. This is above the 80 level. This is coming down because every time it gets there, it does that. Yeah. But it's not a timing tool. It's a condition tool. It's telling you the condition of the market. It doesn't tell you when the market is going to move. And that's why you use a signal indicator like the reversal alert indicator, a 3-bar reversal pattern, a moving average cross. That's the signal when the condition is met. This is what strategies are made of. They're made of a condition in the market that is repeatable and a signal that shows you a bias is starting to form. That plus that equals trade. Once that happens, you still have a 50-50 probability of actually that working out in your favor, but the condition puts the odds in your favor. If you see the yen bucket index being like that, or the currency strength meter showing that, it means that that has happened. The inverse is coming because that does not go on forever. So when I see indices, it's a little bit like the sentiment indicator. When you look at retail sentiment, that's part of this new website. They've got a retail sentiment. It's kind of a scrape of all the brokers in there. If that says that everybody is going one direction, you do the opposite because it means they've been piling in, which means they are going to get out. It's the mean reversion. So everything you see that has moved, this is why I'm a mean reversion trader, not a trend trader, because it's much easier to identify when something's done something and predict the next path than it is for something to be doing this and predict the next path, or for something to have done that and assume the next path, which is why trend trading is so difficult. If you see something trending, you've missed it. Revert it, because things don't trend very often for a very long period of time. Looking at things like this, yeah, I mean, that's a parabolic move, obviously, but trends always have pullbacks in them. Yeah, this one's got a few little pullbacks in it, but it hasn't had a proper pullback yet. It will do. So we know that this is coming down. It's just a case of when. Look at that on the 4 hour. I mean, that is a signal and a half, isn't it? That 4 hour, 3-bar reversal going in. Didn't get extended on the hourly though. Yeah. So this is again, this test I've just done here. You know, if you run this and switch over to the 4 hour RSI, you'll get very few signals, but you'll probably find the strike rate is even higher. We'll run it and see. But I mean, you won't get many trades. 4 hour RSI 80-20 is, you know, on the yen pairs, it's a lot more prevalent because they squeeze. They trend, don't they, because of the way that it works with the safe haven and with the carry trade. The yen has always been a carry trade. This is why the yen has always done what it's done, because the market uses it to carry swaps. That's why it's called a carry trade. There you go. So there's your strike rate. It's 100%. You didn't make much money because you didn't take many trades. But, I mean, you got into 3 trades there, 1. You got into 1 trade, 1. You got into 1 trade, 1. You got into 3 trades, 1. You got into 1 trade, 1. But in 2 years, you took 1, 2, 3, 4, 5 trades in 2 years. But why not get in with this 10% risk? Go in super risky on it. You know, if you stick going with 5% risk and target 1 ADR instead of half an ADR, see what the profitability is like. Completely changing the parameters of the test, obviously, but there we go. We had to do some drawdown there. But, you know, we came out up, break even. Yeah, we came out break even, didn't we, really? But, you know, you've made 15%. More trades than that, isn't there? Yeah. 27%. we go. Made 28% with a 47% strike rate, having taken 17 trades in total. So you took a loser, a loser, a loser. So these are drawdown controls, 40% drawdown controls before getting out with a profit. And that profit brought us back to break even. Didn't lose anything. We just came back to break even. We just had to sit through the trade for 6 months because it's a 4-hour time frame. You're trading daily, aren't you? Straight in, straight out, 5% profit. Straight in, straight out, 9% profit. Oh yeah, because we're targeting one ADR. Few drawdown controls, profit. So £1,000 or $1,000 per trade. We're risking 5% over one ADR. We're targeting one ADR. Just, it makes a lot of money. But you're sitting there all year waiting for a trade. When it comes, though, you get paid. This is why I love seeing the RSI. I love seeing it squeezed on the 4-hour up to these sorts of levels. 90 level, not in the yen, I mean, but other pairs. If we look at the euro US dollar that we just did that test on, if I could find it, 4-hour, you don't get many opportunities. One there, one there. You have got a few actually in this case, haven't you? So scaled in, out, 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 out. That one possibly might have been a multiple scaling over a period of, in this case, 4 weeks. So reliable, so reliable. Anyway, do some testing on your own. There we go, Peter. We've covered it. Sent you a screenshot as a message on Discord. Oh, send it in the members group so we can all see it. I'll forward it. So yen basket is the Aussie yen, CAD yen, pound yen, euro yen, and US dollar yen. Yeah, you see that to me is no use whatsoever. Because all you're doing there is you're getting a reading of how strong the US dollar is, the euro is, the pound is, and the CAD is, and the Oz is. Yeah. If that powers up, that powers up, that powers up, and that powers up, and that powers down at the same time, this thing's going to go like that. That doesn't mean the yen is weak. It means that the euro is strong, the pound is strong, the CAD is strong, and the Aussie is strong. You see what I mean? This is not telling you the strength of the yen. This is telling you what the crosses are doing against the yen, which doesn't mean the yen is strong or weak. It means if they're all taking advantage at the same time, obviously this is going to come down, but it doesn't help you in any way, shape or form, does it? So if, for example, let's say the commodity pairs start to rally, this will go down. If these suddenly start to drop, just as the euro and the pound increase interest rates, this will continue to go down. If these two go neutral because nothing's happening and the dollar suddenly screams through the ceiling, this will continue to go down. But it's not going down because the yen is weak. It's going down because the dollar is strong, the euro is strong, the pound is strong, the commodity markets are strong. If the commodity markets suddenly drop and the euro and the pound drop interest rates at the same time, this index will fly up. Not because the yen is strong, because the commodity pairs and the European markets drop. You see what I mean? It's a currency strength meter in effect, but not for an individual currency. So you're better off using a currency strength meter if you want to know how strong a particular individual currency is. I mean, if you find it useful, use it, obviously, but just make sure you understand how the calculation is working and what it is, in effect, telling you. It's not necessarily telling you what you think it's telling you. It's exactly the same as me coming on here and going, the Swiss yen is going up. The Aussie yen is going up. The CAD yen is going up. The pound yen is going up. New Zealand yen's going up. And US dollar yen's going up. That tells me that the yen is weak. But if the US dollar yen is coming down, the CAD yen is coming down, and the other three are going up, that tells me that the US markets are weak, but the European markets are strong. It doesn't tell me anything about the yen, because you've got different pairs doing different things at different times. So that tells you that the yen is neutral and the others are pushing it about. But, this is the trouble with everything that you see in trading. It's subjective. You can look. Someone can look at that and just trade it like a normal chart, technical, and get on absolutely fine. But it doesn't mean they're trading just the yen or anything in particular, does it? DAX has moved, is it? Woo, brilliant. The one I didn't get on today. Got no leverage on that account now at the moment. US markets are flat, aren't they? Nice move on the DAX. Right, I've got to go. I've got this man coming round. I don't know how to access special member group in Discord. You just link your Discord account. It's all in the members, in posts. There's this this here. So this explains how to do it. So in your Discord, you just go down to your settings. Explains it there, basically. Click the little cog in the bottom left next to username, and then go to the connections tab and add YouTube as a connection. You obviously need to log into your YouTube account, and then you will automatically be allocated a role in Discord that you are a YouTube member. And then that gives you access to the members group. I said on the end of that, simples. Some people don't find it simples because they've got if you've got a joint YouTube account, which you share with other people, doesn't work. It's got to be your own YouTube account and yours only. So, right, I'll leave it there today. Anything else you need, let me know. If you've got anything else you want to discuss like that, obviously you don't. If you're watching this on replay, you don't have to be in the group, as Pete never comes in the group. I think basically Pete's in America, so he can't make it to the morning because members' sessions are always in the morning. So I get messaged basically to say usual talking stuff. So so if you've got anything you want to cover, if you're watching on replay and you've got something you want to cover and you can't make the live rooms, let me know and I can obviously cover it. I can plan a session on it like I have today and I can cover it. And if there's anything specific you want to look at testing-wise, strategy-wise, anything like that, just let me know. And obviously I can plan a session out on it basically then. News-wise today, obviously, we've got FOMC meeting minutes this evening, but there's no other news today. So don't expect masses of movement today unless Trump says something, which is potentially on the cards, obviously. So that's it for today. I will be around in Discord and Telegram. I'm back at 2:30 this afternoon. We'll trade the US session. I am assuming I'll be back this afternoon at 2:30. This guy's meant to be here for about 4 hours today. So fingers crossed. But yeah, so I'll be around this afternoon at 2:30 for the US session. Obviously, we'll be doing normal trading then. So anything else you need, let me know. Otherwise, I will see you next time. Have a good day.